So don't be me. If you wanna go, you can leave.
Hello, and welcome back to Beta Accounting Tutor. Today we'll talk about bad debts. Bad debts occur when a customer on credit does not pay their balance. It's like the one friend that borrowed money one time but always forgot to pay it back. After a long period of time, businesses may choose to write off bad debt in order to claim the tax benefit instead of waiting on the customer who is not likely to pay them back. There are two ways of calculating bad debt expense: direct method and indirect method. Direct method is simple. You claim the bad debt expense every time you write off a specific account. This means every dollar of bad debt expense can be directly accounted for by an account receivable that was written off. Suppose you have 3 accounts receivable that total $15. Under the direct method, you would claim your bad debt expense the moment a customer lets you know that they're unable to pay you back. For example, if Annie, who has a $5 balance in her account, came and told you that she couldn't pay you, you would write off her account, and at that moment, you would claim a $5 bad debt expense. And your journal entry might look like this. Since you're writing off an accounts receivable and it normally has a debit balance, you would cancel it out by crediting it by the amount that you're writing off. And you would write the matching debit under bad debt expense. Suppose after a while Annie came back and said that she will indeed pay you back the $5. So what do? Her accounts receivable is now gone, it's been written off. In this case, you would have to simply retrace your steps. You might be tempted to simply write off the bad debt expense and show the receipt of cash. However, this would be wrong. What you would have to do is first revive the accounts receivable and then you would show the receipt of cash. The reason we do this is to show the correct flow of cash. Annie isn't simply giving you money out of the goodness of her heart. It is to pay off an accounts receivable that was previously written off. Therefore, in order to clearly show where the money is going and for what reason, that's why the accounts receivable has to be brought back before being written off again. Another way is the indirect method, also known as the allowance method. This method is a little more complex, but it's actually preferred by companies and shareholders alike because it gives a more realistic estimate of net realizable value of accounts receivable. First, bad debt expense is estimated at the end of an accounting period. There are many ways to estimate bad debt, but most methods are based on either percentage of credit sales during the period or percentage of average accounts receivable during a period. There is another method called aging of receivables, which uses a multiple-step system to determine bad debt expense based on the age of individual receivable accounts. For example, you can expect someone to pay you back after a week, but it becomes less likely after a year. Once an estimation is made, this amount gets claimed in bad debt expense, which is debited since it is an expense account. However, since there aren't any specific accounts receivable that can be linked to this bad debt expense, the balancing credit goes into an account called allowance for bad debt expense or allowance for doubtful accounts. At this point, none of the accounts receivable have been touched and the new accounting period begins. When a receivables account is determined to be uncollectible, then the actual account has to be written off and removed from the books. then the uncollectible portion of the accounts receivable is credited and the balancing debit now comes out from the account. The uncollectible portion of the accounts receivable is credited and the balancing debit now comes out of the allowance we created earlier. Bad debt expense remains untouched. Seems like the long way around to get to the same conclusion, so why do companies prefer the allowance method? As mentioned before, the allowance method gives a more realistic estimate of how much cash they can expect to collect from the accounts receivable. The allowance account we estimated in the first step is what's known as a contra asset account, which means that while it sits on the asset side of the balance sheet, it actually takes away from the parent asset and has a normal credit balance. It can't sit on the liability or shareholders' equity side of the balance sheet because we certainly don't owe the amount to anyone, whether it be a creditor or an investor. However, it is a balance that negatively affects my accounts receivable asset. Another contra asset account that you may be familiar with is accumulated depreciation, which is normally linked to equipment. If you lent $10 each to 10 friends, but knew that one of them weren't likely to pay you back, then you can only reasonably expect to be paid back $90 despite lending out $100. If we use the direct method, we would have to wait a long time to actually determine that we're losing $10 in this deal. But with the indirect method, the $10 we're not expecting to be paid back would fall into the allowance account, effectively lowering my accounts receivable and giving me a more reasonable expectation of what I can collect later on. Well, we hope this video answers your questions about bad debts. Don't forget to like and subscribe, and we'll see you next time.
Waking up to nothing when you're super far from home, and I watch you